welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct. And after 3 consecutive weeks of gains, the Australian share market has seen a mild pullback. We have seen a lack of catalysts post-reporting season, and we're also in that season where dividends are being paid, so those ex-dividend dates having an impact on the market. But still, we are seeing a softening outlook for the domestic economy. So let's kick off with UBS, which is looking at the housing market, saying that loans are already down 25% from the peak, but they expect loans to be down at least 30%, and there's a rising risk that we might see them down as much as 40% from the peak. In January, we saw home loans falling 2.1% month on month, and that means a fall of 20.5% year on year. That's the worst since the global financial crisis. Now, this is important because it's the key lead indicator of the credit tightening thesis that UBS has. They say that home prices is home loans. Investor home loans, of course, down 29% year on year, but also owner occupiers are down 17%, while developers also weaken. Those accelerating fall in home loans shows the tighter credit story playing out. They do maintain their peak to trough forecast of house prices dropping 14%, even assuming Reserve Bank rate cuts. In Sydney and Melbourne, they expect those price falls to be closer to 20%, and they forecast that the Reserve Bank will cut in both July as well as August this year. Of course, those softening house prices have impacts in other areas of the economy through a negative wealth effect. And Wilson's having a look at one of those areas, which is automotives. We know that new vehicle sales have been soft, and that impacts on stocks like AP Eagers, Automotive Holdings, as well as Autosports Group. But also new bike sales have continued to slide, impacting on Motorcycle Holdings, and the aftermarket also impacted by consumer sentiment. So these are stocks like ARB, GUD Holdings, as well as Bapcor. The only buys that they have on this space are Automotive Holdings as well as the Autosports Group. Moving on from automotives to healthcare, and we do see a federal election this year, so watching this space very closely given its dependence on federal government spending. Having a look at Ords and what they are saying about the healthcare space, and they expect that the demand for outpatient services, that's pathology, imaging and GPs, to normalize in the second half, although the impending federal election and the early budget release is likely to have a greater impact on share prices. They continue to see potential upside for Healius, HLS, and to a lesser degree Sonic Healthcare, SHL, through their exposure to Medicare funding. The Labor government has been saying they will boost their spend, so hopefully that will have a flow-on effect for these two stocks. While hospitals may come under pressure given that Labor's proposing a capped private health insurance policy at 2% per year. Having a look around the region, and China's equity market has been off to one of the best starts in 2019. So Morgan Stanley looking at a China equity strategy, and they've come up with their own indicator, the MSASI, which is an aggregate of 9 metrics on the Chinese stock market. It's a rating of 0 to 100, with below 50% indicating fairly stable and over 80% being associated with sentiment alarm. At the moment, the reading is at 51%, which is good to hear. That's versus 100% during the 2015 cycle peak, and that's why they reiterate their overweight rating on China A shares. Their base case index target for the CSI 300 is 4,300 points. And of course, Australian investors can gain exposure to Chinese shares through things like ETFs and IZZ, which is traded on our market, or through fund managers, which concentrate on the Chinese market, such as Platinum PTM. Having a look at retail REITs, and Citi has just hosted its Global Property CEO Conference in Florida. Some of the things to come out is that e-commerce is by far the biggest disruption to retail REITs. Turning that disruption into an advantage still remains challenging, with limited evidence to date that they're able to do so. They are seeing oversupply in the retail space in the US, but also in other markets. And hence, because of that weakness, retail REITs are looking to mixed uses for their properties. So that's very much in focus. Having a look at Citi, and they have a sell on GPT, Essentia, as well as a neutral on Vicinity. Macquarie having a look at iron ore this week, and Australian shipping rates have recovered. Shipping rates for key WA ports have recovered after a tough start to the year, but over in Brazil, shipments have been impacted by weather. The good news for Fortescue is that pricing differentials between high and low grades have contracted. Rio and Fortescue are on track to hit their guidance with risk for BHP, but they maintain an outperformance on all three: Rio Tinto, BHP Billiton, as well as Fortescue. So no doubt we'll be continuing to watch those dividends roll in to bank accounts as well as those ex-dividend dates, but the market really looking for a catalyst to move the market higher. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.